Welcome to the 2018 webinar, Q1 webinar. It's back. Volatility returns to the market. I'm Bob Klefsis, president of All Star Financial. Want to talk a little bit in Bob's corner about the Tax Reform Act benefits. There's significant benefits that are coming through as we speak today. Individuals, surprisingly, 95% will pay less taxes in 2018 and beyond. Some corporate benefits obviously starts with 35% to 21% tax reduction. That's a 14% percentage of revenue that's going to drop to the bottom line, hopefully, at least a part of that. The corporation, another benefit is the repatriation of over somewhere between 2 to 30 trillion. Nobody has a really good grasp of what is happening overseas as far as the dollar amount. They believe it's about 50 trillion, but anywhere on the low side of 2 trillion to 30 trillion could be coming over with a 10% tax, one-time tax that they get 8 years to pay on. So really great benefit. And the last benefit for corporations that's significant is that capital expenditure write-offs with heavy equipment have been increased. So good news versus bad news. Is the tax reform a good thing or is it a bad thing? I think good news-wise, there's going to be significantly more spendable income for individuals and a better bottom line for corporations, no doubt. I think from a standpoint of bad news, that could force the Fed to liquidate or to raise interest rates too quickly, and creating that inverted yield curve would be a negative scenario. 5 of the last 7 recessions have been caused because the Fed raised interest rates too quickly and stunted the economy. So it's a cycle that we go through, but they're walking a fine line, and I'd hate to be them in the next 6 to 18 months. Market overview, again, volatility is back. Kind of the event timeline for the first quarter. We saw a strong January where equity markets and global markets were ahead by almost 7.5%. We had some fear come into the equation that too good was too bad with having to maybe raise interest rates too quickly. And we saw our first correction in over 2 years of more than 10% of its value as an intraday correction. Again, interest rates, continued to trend higher. We had a 30-year secular decline of interest rates from 1982 to 2012, and since then we've been bouncing, and now we're definitely headed higher. Core bonds lost about 3% in value in mid-February. Again, bonds can be your friend, but it also has a negative inverse correlation to interest rates. But March 2018, our bonds kind of stabilized. So we saw them interest rates go up and interest rates go down. Some factors that we want to talk about that talks about the market turbulence would be on the good side, there's that momentum of the economy, and that's as strong as we've seen for a long time, and we'll talk a little bit more about that. On the bad side of the equation, we have Trump talking about imposing tariffs on steel and aluminum, and that freaks everybody out. Not everybody realizes that these don't go into effect for at least 6 months, so this is kind of a negotiation time period. Another bad thing that nobody has control over these days is really that data privacy. Facebook got hacked, subscriber concerns on Netflix, and obviously self-driving car problems with NVIDIA and Tesla and the big accident there. So fundamentals remain very positive. Both the U.S. economy, corporate earnings are going to continue to grow with Tax Reform Act. And again, those are really, really positive things. Estimated S&P growth at about 17% this next quarter. So that would be, or 17% for the next 12 months. That would be awesome. Global economic growth projected to exceed 3% for the first time in many, many years. The U.S. economy, let's talk a little bit about the 105-month streak. We've continued this streak in consecutive months of economic expansion. In the last 3 quarters of 2017, GDP expanded by 2.9% on average. On an annualized rate, GDP is expected to top 3% in 2018. And consumer spending rose 4%, so people are seeing more money in their paychecks. And that going to the bottom line, and obviously people are spending that Unemployment is as low as it's been in a lot of years at 4.1, and we have very meager inflation over the last 12 months. So, looking ahead, we need to be concerned that we really play the game tactically. We're well past the midway point of our economic cycle domestically, and we need to make sure that we're doing some tactical things. Important signals that we'll be looking for, and how that affects the interest rates is low unemployment, increased earnings, higher inflation, stronger consumer sentiment. All those are good things, but may cause, as we kind of talk about the icing on top of the icing on top of the cake, that interest rates have to go up too fast because the economy is overheating, and we don't want to see that. So tax reduction again is, it makes the Fed's job really, really difficult here. If we talk about the bond market, again, yields took a wild ride. We saw bonds, go up a 10-year almost to 3%, rose to 0.54. Then they backed down and leveled off at 2.74. But again, a rising interest rate environment caused that 10-year Treasury to lose 3.6%. When was the last time, when was the last time that you lost money in bonds? Well, 10-year Treasuries took a big hit. So again, those are the things that you need to actually tactically manage and proactively manage. And we think we've done a really good job. Aggregate bond index here declined 1.46 for the 3 months, managed a positive return for the last 12 months. And then really the only Treasury issued in the last quarter that was positive was the 3-month 90-day at 0.26. So short term was good. On the high yield side, which has really been our friend for a long time, they lost 0.93, obviously relative to the other indices better, but not quite as good as the global bond market, where we saw the global Barclays index up 0.881. Our portfolio performed better than any of the comparatives. We only lost 0.60 compared to the negative 1.46 for the U.S. aggregate. And again, that was due to our floating rate bonds as well as our international bonds that helped us. Looking ahead, Q1 shows, a relationship, again, between interest rates and bond returns is going to be, the ticket going forward, Q2, excuse me. Bonds are susceptible, obviously, to the interest rate hikes and the Fed. And interest rates, again, they're going to drag on the economy because the bond part of the portfolio will not obviously perform as well. Domestic stocks, when you look at the winning streak ending, S&P lost 1.2%. The Dow was 100% plus more than that at a negative 2.5 in the first quarter. The Russell 3000, which is our broadest index, was relatively flat. That's 98% of the market value in the world within those 3,000 stocks. The Russell 3000 growth side of the value side of the equation declined by 4%. So growth outperformed value, and small cap outperformed large cap. So small cap index was down 1.3, where the large cap was down a little bit greater at 1.9. Technology stocks did a great job at a positive 3.7% gain. Consumer cyclicals were close behind at a 3.4. And then the losers, worst performers for the quarter were again telecom and energy. So they're getting to be a pretty good buy right now. Looking ahead, we look at PE ratios on the S&P 500. It dropped from about 25.5 to 24.5 at the end of March. Corporate earnings growth obviously is going to remain positive for 2018 with all that tax benefit coming to the bottom line, which we feel leaves room for stocks to gain some more ground. And the S&P 500 companies, again, are projecting a 17% earnings growth for this next year. Global markets, international markets, had a little bit of a setback there too. International markets underperformed, mostly due to the fear of the trade tariffs and what Trump has been spouting. MSCI, the all-world index, lost about 2.34. about the same as the S&P 500. European stocks lost a little bit less than that at 2. Japan actually made a positive return out of kind of a lemonade out of a lemon. They gained at 0.1% gain based on the fact that some fear went away from that side of the world in the Korean situation. Emerging markets did much better. The MSCI Emerging Market Index was up 0.1, almost 1%. Latin America had a phenomenal return for the quarter, 7.2. Some of this was due to currency, but most of it was due to basically just valuation and people realizing. And then All Star Financial, what did we do? And our performance outperformed the benchmarks. We had a gain of about 0.8% on all of our international equities. International, looking forward, investors, we entered 2018 optimistic. I think the focus turned to the central bank. New restrictions on trade and general geopolitical unrest is going to kind of go ahead of time too, or looking forward will be a problem for us. But again, the Asian kind of the benefit for them is the relations between North and South Korea and the U.S. thawed, and they took advantage of that from an earnings standpoint. Non-U.S. markets still are more attractive than the U.S. stock market right now. PE ratios are looking at 13.7. As I mentioned, the S&P 500, we're looking at 24.5 PE. So for every dollar's worth of earnings, would you rather pay $24 or would you rather pay 13.7? So again, international still bring to us the best value around the world. Real quick summary on 2017. After the bottoming in 2009, the stocks have gone up 300%. That's an amazing number. Unemployment has dropped, from 10% to almost 4%. Turnaround due to really the low interest rates, low inflation, quantitative easing has already helped our situation, obviously. But the big question is how long can the economy continue to grow before a recession hikes? Again, icing on top of the cake. There's some tailwinds here that may force the interest rates up faster than what we would like. But again, that would be good news for all of us too. And All Star Financial, again, we're monitoring those trade restrictions, those potential regulations on technology, and obviously geopolitical tensions are always what we're looking for. But again, driver for both the upside and the downside has been the uncertainty. Basically, volatility has come back. Volatility is basically because of uncertainty. So when you look at volatility, it's a good measurement where you can show that we had over 400 days where we didn't have a significant drawdown and negative in the market. You can see these shorter time periods where we had a lot of downturn. It took 400 days before we had any significant downturn in the market there, which I thought was really interesting. This one I feel is interesting too. We talk about the volatility, how the volatility has increased here. You can see a moving average of volatility, and that volatility, when it increases, the moving average goes down. And you don't ever want it to kind of go through that 200-day average. It did bounce down below it and then bounced right back up. So I think we're in a better position right now. But there were a few days there at the end of February and the beginning, or end of January and the beginning part of February that were kind of scary from a total volatility standpoint. Just for fun, we always talk about a restaurant recommendation. The Anchor Fish and Chips has been in North Minneapolis for quite a while. You don't really need to go over the pond to get fish and chips. They have great ones. I just tested it out last week. We have a recipe of the quarter, steak kebabs, as we see, the barbecue days hopefully coming sooner than later. If we look outside with all the snow, that it's hard to imagine, but hopefully you'll enjoy the steak kebabs. And then the quote of the quarter, one of my favorite, is great things in business are never done by one person. They're done by a team of people. And I can't tell you how much pride I have in the team and the staff that we have at All Star Financial. We want to thank you for your continued support and trust in the All-Star team. And again, remember our referral program. We'd also like you to join us on Facebook and LinkedIn or YouTube. And again, send us to your neighbors and friends and family. Want to increase that awareness of what All-Star Financial and the uniqueness of what we do and into the public. And then again, our team of 10 right now will actually grow to a team of 11. But all the way from myself, who founded the company, to Jaron, who will be our new um, assistant portfolio manager, who is coming from the University of Minnesota grad program. So looking forward to having Jaron on our team. Jaron comes from born and raised in China and did his studying in the United States so far. So we're lucky to have him. So I want to thank you, everybody, for the time that you've spent with us today. If you felt like this was worthwhile, pass it along to a friend and family. That would be ideal. And again, make sure that you never ever go a day without giving us a call if you have a question. We always like to challenge our clients too, that kind of stump the chump. Hey, if you see something, you read something in the paper, you see something on the news, give us a call. If you have any fear at all, more than likely we've seen it, or we can respond to it and ease your tension. So thank you for your time, and I'll look forward to saying hi to you, clients that are coming in here very quickly. And those of you who are not clients, give us a call. Hopefully we can help you out. Have a great day.